Alright guys, welcome back. So today we're going to talk about Season 5, Episode 2. Now what I do on my show here on YouTube is that I cover the financial portion of Billions. I'm not interested in the gossip and all the other stuff that happens on the show. I just want to explain to you the financial side of what's happening, and hopefully it makes sense to you, and then you can go out and be smarter than that friggin' neighbor of yours. Our first encounter happens around 9 minutes and 45 seconds into the show. This is when the governor comes into the room and he basically says that, hey, those crypto miners damn near decimated that town. City council had to go out to the markets and buy electricity at 10 times normal rates. So of course, the obvious question here is, what does that exactly mean? What does it mean that those crypto miners decimated the town, and then why did the city have to go out and buy electricity? Well, to make things very easy, when you mine cryptocurrency, what ends up happening is you use a lot of electricity, a lot of computing power. So what happened essentially with the town is that now we have these guys stealing electricity to run their crypto miners. Now, the town has a certain allocated amount of electricity, and that electricity has been juiced away. So the city council actually went out to the open markets and actually purchased wholesale electricity. This is very interesting. Just like you can buy barrels of crude oil, just like you can buy soybeans and wheat and so forth, you can actually go out and deal with the energy markets, and you can actually purchase contracts in electricity, and you can buy actual excess electricity from other wholesalers. Now, why the city had to pay, say, 10 times the cost as they're talking about here? Well, that would make kind of sense, that because the city ran out of this juice very quickly, the city hadn't allocated for it all that electricity. So when they went out to the open markets, everybody knew that the city needed a lot of electricity, and therefore what happens? When you need something real fast, the price generally goes up. So this reference that we just saw that began at the 9-minute 45-second mark is essentially a conversation about the electrical markets, the energy markets, and how that market is actively traded, not only by hedge funds and traders, but also by large pension funds, large institutional funds, and more individuals like you and me can actually go out and trade in energy futures, especially in the electrical markets. All right, the next money-oriented conversation that we get happens at the 12-minute and 41-second mark. Essentially, you have Axe, you have Wags, and you have Taylor. They're standing around waiting for this Prince guy, and they talk about getting into psychoceuticals. So what Axe and Wags are talking about is that they want Axe's hedge fund to actively start investing in biotechs and other pharmaceutical companies that will benefit from and profit from selling this new coming psychopharmaceutical trend. And the interesting thing that we need to understand here is that Wags and Axe are waiting for this guy Simon, who I guess runs this company called Eric's. This guy Simon wants to be at the FDA, and the rule there is that the FDA requires that these guys who are in the high-end positions will have to divest themselves of companies upon which the FDA is directly managing. So what's happening here is that this guy Simon is going to have to sell all of his shares of whatever company that he owns. And then Wags and Axe want to go in and buy those shares either directly or through something naughty that they'll do. But essentially, they want those shares directly from this guy Simon into Axe's personal account. What this ends up doing is that the company, these shares, whoever owns them essentially is going to become a majority shareholder. Therefore, that person is going to be able to exert some pressure on how the company moves, how the company navigates itself. And of course, because this is Billions, they want to go in and capture this company before it starts selling and making all this boku money. So Wax and Ags, using Taylor, they all want to get those shares directly from Simon and have them transferred into Axe's control. So the next set of jargon kind of begins at the 14-minute and 15-second mark. Here we have Dollar Bill talking to this guy, and he says to him, hey, you've got yourself a secret golden tunnel. You're running your own money. It's not illegal, but enough to get you fired. Now, what exactly does that mean? What Dollar Bill's talking about is that this guy who likes using the bathroom, what Dollar Bill is talking about is that when you are managing money, especially in an environment like a hedge fund, you're supposed to disclose to your clients and sometimes even to the government where exactly all your money is. So if you have 2 or 3 different trading accounts, what you're essentially doing is you're trading at a separate discretion level relative to what your clients are getting. So that's essentially a conflict of interest, because say you inside the hedge fund are buying a lot of tech stocks, Microsoft, Adobe, Apple, Google, whatever, any of these guys. But in your own private account, you think that tech's about to crash and everything is going to hell. So what if you short all of those? Well, what you've essentially done is you've created a conflict of interest, haven't you? Because in one location, you're long all these shares, that's for your client, and in your own private account, you're short. That's kind of a no-no. Now, another way where having a separate account can be problematic is something called front running. Let's use that same example again. You own a bunch of Microsoft, Google, Amazon, that whole complex. Now, what if you find out that your hedge fund is now about to buy tens and tens of millions of shares within those companies? Well, you're now kind of front running because you know that your hedge fund is about to buy a lot more shares, and when these companies start buying a lot more shares aggressively, especially in the open markets, the price of these stocks tends to go up because there's a sudden influx of demand. So having this private separate account essentially is letting you benefit while your client, your customer, is not getting the best execution. So it's kind of a no-no in this industry for you to have separately traded accounts, especially for yourself. So the next set of interactions are very interesting. We're now around the 14-minute, 48-second mark. And here you have Dollar Bill. He's still kind of interrogating this guy, Winston. And he says to him, Dollar Bill does, he says to him that, I know that you've got a 3 Sharpe strategy. And Winston kind of smirks back at him and says, no, it's actually 3.64. So what exactly is happening? What's happening here is that in the financial markets, one way for you to analyze the risk in a portfolio is to actually look at the Sharpe ratio. And what this Sharpe ratio, there's a little bit of math involved in it. It's not too complicated. I'll have a link to it down below. So I want you to think of a Sharpe ratio as nothing more than a way for you to say that relative to the risk in my portfolio, how have I done? So in this world, a Sharpe ratio of 1 to 2 is kind of considered good. When you go from 2 to 3, you're really saying that I've got this badass strategy and I'm making a lot of money without having a lot of risk relative to what I'm trading. So essentially when this guy Winston barks back and says, hey, I'm actually at a 3.64, what he's telling Dollar Bill here is that I've got this badass strategy and it's making a lot of money and I don't have a lot of risk on it relative to the other instruments. So in your world right now, I want you to understand that a high Sharpe ratio is actually considered very good. And then here we have Winston continue and he says, but only in the 6 figures. So essentially he's talking about the millions. What the point Winston is making here is that if he takes on a lot more money and puts it into the strategy, he may actually jack it up. So let's kind of look at it through a rough example. And we're going to go back to that same example I used earlier today when I talked to you about all those tech shares. Now, say Winston owns a set of companies, say Winston owns a set of stocks, and those stocks are okay with him jumping in and out of it at around a 4, 5, 10, $20 million range at a time. It's a big range, but there's enough liquidity in those instruments that Winston is able to buy about $20 million worth and sell about $20 million worth. Buy $5 million worth, sell $5 million worth very quickly. His argument to Dollar Bill here is that, hey, if you actually give me more money, or in this case, if you force me to let you invest with me, what's going to end up happening is that the strategy I have with this very high Sharpe ratio is going to get jacked up. And not only is the Sharpe ratio going to fall, I'm probably not going to be able to generate the same type of returns that I was doing before. So it's essentially setting up a tension point here because Dollar Bill wants that money. And this guy Winston says, well, I've got the money, but I'm not going to let you participate in it as I make that money. All right, the next one here is Wendy. This is happening around the 20-minute 37 mark, and she tells the girl from Mace Capital, hey, I need you to gentle down an investor. She's a beast. So what's happening here? Well, what's happening here is that the hedge fund, Axis Hedge Fund, has currently being visited by one of their clients. This is probably someone from a large pension fund. So they've allocated maybe a couple $100 million, sometimes in the multi-billion of dollars. It may surprise you that CalPERS, which is the California Public Employees Trust Fund, that has around it has around $330 billion of assets under management. So these guys from that fund, they go around the country, they invest in various hedge funds, they invest in companies and hedge funds like Bridgewater and some of the other second-tier firms out there. And basically what these pension funds do is they tell these various hedge funds, I will invest money with you, and then you're going to give me some type of a return, and that return better be good. And this is where that Sharpe ratio comes in. They're going to be looking for decent Sharpe ratios. They want money in the market, but they don't want a lot of risk from those type of investments. So anywho, what we're having here is this lady, she's trotting around, she thinks she's a badass, and she's basically here to squeeze these various traders. She wants to look them in the eye and see if they're going to be able to answer her supposed tough questions. And that somehow is going to give her a sense of comfort because now she feels that her pension fund, which she represents, is within safe hands. So this is a lot of shits and giggles type of thing. This is essentially a marketing ploy. And Wendy understands that, you just need to calm the person down. You need to kind of speak to them in the language that they're expecting. And if you do that, this person from the pension fund kind of disappears and the hedge fund gets to kind of keep that money and continue trading on it. So what we're seeing at this moment in time is essentially how marketing is being handled inside this particular hedge fund. So we're now going to kind of jump towards the end because that's where the rest of the action for this episode is. And now at the 47-minute and 30-second mark, we've got Dollar Bill freaking out because guess what? Winston had already told him that I'm not going to be able to handle all that money you're going to add to this, and I'm not going to be able to trade well. And boom, he's not able to do it. So now Winston is kind of sitting there smugly because he's saying that his quantitative fund cannot handle all this money. Dollar Bill is upset because he feels that not only is Winston not performing well, Dollar Bill now also feels that this new type of trader, these quantitative traders, they call them quants. These are guys and gals who use mathematics, who use algorithms, who use programming to essentially create trading strategies, and then they use machine learning for finding newer strategies. So Dollar Bill here kind of feels that a computer is kind of beating him, and more importantly, as you can pick up from the tension in the scene, he's kind of upset that this little dorky kid is kind of whooping Dollar Bill's ass. So this is what this whole tension's about, this coming age of quantitative funds and this movement away from these discretionary type traders. And these are guys and gals who kind of traded by their guts or they traded via market sentiment. So at the 55-minute mark, we've got this argument now between Axe and Prince, where Axe says to Prince, "You stole my shaman." And then Prince comes in and says, well, he belongs to the world. And essentially what's happening here is this tie back to that conversation we had earlier in the show about getting those shares in that company so that Axe is going to be able to benefit dramatically from this new psychopharmaceutical craze that's apparently going to be coming. And by Prince taking on that shaman, what he's done is that he's taken this thought leader, he's taken the guy who may be the spiritual leader of this new coming trend, and he's taken him and put him into his own camp. So this weakens Axe's position, and now Axe is going to have to struggle to get that posture back towards him. So at this moment, because the shaman, who is the leader of this movement perhaps, has now hanging out with Peter and not with Axe, this weakens Axe's position entirely. So as the show comes to an end at the 56-minute 39-second mark, we essentially get the crux of the matter. Axe is now pissed because he's not going to be winning in this psychopharmaceutical craze. And at the same time, he's kind of irritated by looking at those smug bankers. Now, what Axe is making reference to is that the current situation in which we are today, where these large central banks, the Federal Reserve, the European Central Bank, the Bank of Japan, all these huge behemoths are giving out trillions and trillions of dollars to these large other banking institutions such as JP Morgan, Goldman Sachs, and on and on. So what Axe is saying here to Wags is that, look man, you and I know this, we take all the risks, we take on all the losses if we make bad decisions, and then you get a bunch of these bankers who take on bad trades, who take on high leverage, and essentially they don't handle their money well. And then what happens? Well, the government comes in and bails them out. And this is where he talks about that there are always these bailouts, there are bail-ins, there's federal easing, and on and on. So what has now emerged into Axe's head is that he's like, why the F are we busy running around trying to run this hedge fund where all the risk is on our shoulders? You remember how that chick from the pension fund came over and was kind of interrogating the crew? You know, those things don't feel well. When these clients come in, they kind of poke at you and they want to find out stuff about you. So Axe is saying, why do I got to go out and fight for a shaman and got to do all this other BS stuff when I could just be this big bank or a banking institution? And then if things get effed up, guess what? The government's going to be here to bail me out. And I think this is what this episode is kind of leaning towards and is going to build. Because the show is billions, I don't think Axe and crew are going to be a very stable bank. I think they're going to take on high risks and so forth. And eventually maybe the government's going to have to come in and bail them out because suddenly Axe has become too big to fail. So we'll see how the episode develops. And that's it. So folks, I've given you some insights today. I hope they were of value. But more importantly, and this is kind of a running joke here, but I hope this information makes you smarter than your neighbor. Our goal here, my goal here is that I want to explain these complicated things to you in a simple way. It does not have to be complicated. It's just that you don't know about these things. And hopefully me talking to you about them increases your interest in the matter and you go out and you learn more. So with that, I'll see you next time. Cheers.